If you live in Germany, 2026 isn't just another year on the calendar. It's a bill coming due. A bill Germany promised it could always pay. And now it can't. Imagine it's January 2026. A man named Klaus opens his pension statement. 40 years of hard work, 40 years of contributions. How can this be? In the next few minutes, you'll see exactly what Germany must pay in 2026. Who it owes the money to and why, for the first time since World War II, the math no longer works. This isn't a prediction. It's already written into Germany's balance sheet. The numbers are public, the commitments are binding, and the collision is inevitable. But here's why you should care, wherever you're watching from. Japan's debt is over 260% of its economy. Italy's pension system faces the exact same math. South Korea's fertility rate just hit a shocking 0.7. And the retirement protests in France? They aren't protests, they're previews of what's to come. Germany is simply the first major economy where all these crises hit at the same time. Watch what happens here, because your country is probably next in line. For decades, Germany ran the most admired economic model in the world. Export-driven industry, cheap energy, stable pensions, and disciplined budgets. It was the blueprint for prosperity that other countries tried to copy. And it worked because three things were always true. Germany had workers, buyers, and time. Workers to produce world-class goods. Buyers across the globe willing to pay for that quality. And time to build surpluses and prepare for the future. In 2026, all three of those things disappear at once. The workers are retiring faster than they can be replaced. The buyers are broke, buying elsewhere, or simply don't exist in the numbers Germany needs. And time, the most critical resource of all, has run out. The preparations that should have happened over the past 20 years just didn't. Political leaders chose short-term stability over long-term solutions. And now, the bill has arrived. Here's the first number that changes everything. In 2026, Germany must refinance over 300 billion euros in government debt. This isn't for new spending or infrastructure. This is just to pay off old promises. Bonds issued years ago when interest rates were near zero. Now, they're maturing in a world where rates are 3 to 4 times higher. That alone would be a challenge, but manageable. If it were Germany's only problem, it isn't. Because in 2026, 3 other massive bills arrive at the same time. Germany likes to think of itself as Europe's responsible adult, the one that lives within its means and preaches fiscal discipline. And for good reason, it has a constitutional debt brake and weathered past financial crises without bailouts. The German model worked, but even Germany doesn't pay off its debt. It rolls it over. When an old bond matures, you issue a new one to pay it off. That was easy when borrowing cost nothing. In 2020, Germany was actually being paid to borrow money. In 2026, that era is completely gone. To fight inflation, the European Central Bank raised rates aggressively. Those German bond yields that were negative are now over 2.5%. Apply that to 300 billion euros of debt, and the math becomes brutal. It means an extra 7.5 billion euros a year in interest payments just on the debt being refinanced that year. This is money that builds nothing and fixes nothing. It's just paying interest to maintain the debt you already have. This is how fiscal discipline turns into fiscal paralysis. But that's not even the bill that scares Berlin the most. The real pressure comes from a promise Germany made to its own people decades ago. A promise that becomes mathematically impossible when a country's population pyramid inverts. Germany's pension system is pay-as-you-go. Today's workers pay taxes, and that money immediately goes to today's retirees. There's no giant savings account. It's a direct transfer. This only works when you have plenty of workers for every retiree. Back in 1990, Germany had 4 workers for every 1 retiree. Today, that ratio is barely 2 to 1. Fertility rates collapsed, people are living longer, and the massive baby boomer generation is now moving from paying taxes to collecting benefits. By 2026, the largest retirement wave in German history hits full force. These aren't projections. These are people who are in their early 60s today. Let's go back to Klaus, our engineer in Stuttgart. In 2026, he retires. He gets his promised pension of $2,400 per month for the next 20 years. He earned it. He followed all the rules. Now, multiply Klaus by 2 million people retiring in that same window. That's nearly 58 billion euros in new pension payments every single year. Here's the brutal math. Fewer workers mean less tax revenue coming in. More retirees mean more money going out. The system is bleeding, requiring ever larger government bailouts just to keep the checks from bouncing. By 2026, that government subsidy for pensions will exceed 100 billion euros a year. For context, that's more than Germany spends on its entire military. And this isn't an accounting problem, it's a voting problem. Retirees are the largest and most reliable voting bloc. Cutting their benefits is political suicide. What if raising taxes is impossible? What if the only other option is also impossible? In Germany, raising payroll taxes on a shrinking workforce that already paying some of the highest rates in the world just isn't an option. Meet Lena. She's 32 and works in Berlin's tech sector, earning 65,000 euros a year. Sounds comfortable, right? Well, after taxes and social contributions, she only takes home 38,000 euros. That's 42% of her salary gone before she even sees it. She watches her retired parents live comfortably on their pensions, while she struggles to afford an apartment in Berlin, where rents have doubled in a decade. Her one-bedroom apartment costs €1,400 a month, nearly half her take-home pay. Lena knows she's funding their retirement, but she also knows the math just won't work when it's her turn. She calculates that if she retires at 67, she will need to work for 45 years to get a pension that might not even exist by then. Meanwhile, her parents retired at 63 and will collect benefits for 25 years or more. She isn't resentful of her parents. She's resentful of the system that promises her less while demanding so much more. This is the intergenerational tension building across Germany, and in 2026, it becomes impossible to ignore. So we've talked about debt refinancing at higher rates and pension demographics that don't add up. Each problem alone would be manageable. But 2026 is the year Germany has to face both at the same time, and we haven't even gotten to energy yet. For the past 70 years, Germany's industrial success was built on cheap, reliable power. Coal from the Ruhr Valley, nuclear plants providing steady energy, and crucially, cheap Russian natural gas. That advantage is now gone, permanently. Phasing out nuclear power by 2023 removed a massive source of reliable energy. Ending Russian gas imports took away the cheapest natural gas. What replaced it? Liquefied natural gas imported at prices 3 to 4 times higher, plus intermittent wind and solar power. By 2026, several long-term energy contracts signed years ago will expire and reset to current, much higher market prices. Companies that were shielded from the full impact will finally face reality. Imagine walking into a BASF chemical plant in Ludwigshafen. For decades, the reactors hummed 24/7. Now, managers are asking themselves, how long until we move this entire facility to Texas? The answer isn't if, it's when. Because in Texas, electricity costs a quarter of what it does in Germany. And when your main input cost quadruples, you don't negotiate, you relocate. BASF has already announced it's shifting production to China and the United States. And they aren't alone. Dozens of energy-intensive manufacturers are making the same calculation. This isn't just about household heating bills. Energy costs are embedded in everything Germany exports. Steel, chemicals, cars, they all require enormous amounts of power. Higher energy costs mean lower profits, which means less tax revenue, a weaker fiscal position, and fewer high-paying industrial jobs. This feeds right back into the pension and debt problem. It's a self-reinforcing loop that Germany can't seem to escape. So why not just borrow more? Most countries would. But Germany is different. It has a constitutional debt brake, the Schuldenbremse. It's not just a rule, it's a reflection of German political culture, born from the historical trauma of hyperinflation in the 1920s. For German voters, inflation isn't just an economic variable, it's a generational wound. Suspending the debt brake is politically difficult, and undermining its legitimacy is dangerous. What about raising taxes? Germany already has some of the highest tax rates in the developed world. Pushing them higher would squeeze an already shrinking workforce and could drive corporations to other countries. Cutting benefits? Cutting pensions would infuriate the largest voting bloc, retirees. Any party that tries faces political suicide. Printing money? Germany doesn't control its own monetary policy. The European Central Bank does, and its main job is to ensure price stability, not to finance Germany's budget. Every option costs political capital. Every choice creates losers who will protest. And in 2026, Germany runs out of easy choices. What happens when the world's most disciplined economy runs out of options? Let me be clear. Germany will not default on its debt. The economy will not collapse. Germany pays with something more subtle, adjustment. Slower growth, maybe 0 to 1% annually, becomes the new normal. Benefits quietly erode. Pension increases don't quite keep up with the cost of living. Healthcare copays go up. Public services deteriorate. Social contracts slowly phrase. The retirement age will have to rise again, beyond 67, maybe towards 69 or 70. And it's the middle class that absorbs the shock. The wealthy can move their assets, and the poor are protected by safety nets. But the middle class faces higher taxes, reduced benefits, and stagnant wages. This won't be announced with emergency speeches or dramatic headlines. It will be a gradual realization that the old model is over. The Germany that rebuilt after the war, reunified, and became Europe's economic engine is finished. Not because of a catastrophe, but because of demographic math and structural change that no amount of engineering can fix. Germany's leaders delayed maintenance on their economic machine for too long. And now, in 2026, all the deferred maintenance bills are coming due at once. Germany's 2026 problem isn't just about Germany. It's a warning for every aging economy facing the same arithmetic. Japan, Italy, France, South Korea. The workers are retiring, the bills are coming due, and the time to prepare has already passed. So here's your homework. Look at your own country's demographics. Check the worker to retiree ratio. Find out when your debt matures. Because Germany isn't unique, it's just first. The only question is, how many years do you have before your country's math stops working? And who pays next? Thanks for watching.